Hey there, everyone. It's Mike Kramer of Ma Capital. Today is Tuesday, September 3rd. It's around 7:30 New York time. It wasn't a great day to the start of September here in the U.S. or in Europe, and it's looking like the economic data this week is going to drive a lot of volatility if the ISM report today serves as any indication of what's to come. The ISM manufacturing report came in, it wasn't a horrible print, 47.2 versus expectations of 47.5. Still stronger than last month, but prices paid came in hotter than expected, 54 versus 52. New orders were much weaker than last month's reading, 44.6 versus 47.4. Employment was just slightly better, still at 46 versus 43.4. Tomorrow we're going to get that JOLTS data. We're looking for 8.1 million jobs, down from about 8.2. JOLTS is a very difficult number for analysts to predict. It's also subject to very large revisions, so we should be mindful of that. Then on Thursday morning, we're going to get ADP employment. We're looking for 145,000. That's up from 122. We're also going to be getting at 10 a.m. that day, ISM services. We're looking for 51.2 versus 51.4. Remember, this is the number that sort of saved the market on August 5th. This was a number that came out following that weaker than expected job report on August 2nd that sent the market lower. This number came out at 10 a.m. and it kind of gave the market a little bit of a bid. Certainly helped to calm some of those fears. But, again, the 51 number on the services side of things isn't really a strong number. This number tends to run a little bit differently than that of the manufacturing number. So I would urge you to take a look at this number and see historically what it correlates to when it comes to recessions here in the U.S. Prices paid expected to drop to 56. And then, of course, comes Friday morning, the all-important non-farm payroll, looking for 165,000 versus 114. Private payrolls, 140,000 versus 97. Unemployment rates expected to tick down to 4.2 from 4.3. Average hourly earnings expected to go up to 0.3 from 0.2 and 3.7% year over year, up from 3.6. So there's a lot of stuff still coming the rest of this week here in the U.S., which is going to drive markets. And, of course, the Japanese yen was back in focus today after BOJ Governor Ueda had submitted a paper, to Parliament talking about the plans for the BOJ to continue to raise rates if the economy continues to materialize as expected. That got the Japanese yen strengthening today, specifically Aussie dollar down 2%, U.S. dollar, Japanese yen also stronger, 94 basis points on the day, and we're down already another 21 basis points in the evening session. Again, we came back to the 20-day moving average on the USD JPY, and for the second time, that's basically the area where we got rejected. Also, you notice on the 10-day exponential moving average, we're also back trading below that. We only got above it for 2 days and weren't able to hold it. So this to me is a pretty bearish setup, just given that you rejected now 2 times at the 20-day and you got above the 10-day exponential for 2 days and weren't able to get above it. So if tomorrow for some reason we're able to see a meaningful move above the 20-day moving average, and you're able to confirm that again on Thursday and actually put together a couple of days above that, that sort of changes things. But until that happens, I think you still have to think that the Japanese yen is going to continue strengthening versus the U.S. dollar and probably strengthening against other currency pairs. Notice also that you have this big level of support right here around this 143, 144 area, lower Bollinger Band. That's your sort of area where you would really look for this thing to stop. If we go through it, you're probably looking at yen strengthening down to about 142 or so. And even when you look at the Aussie dollar, also potentially setting up a further strengthening there. When you look at it versus the euro, again, very similar, not really able to clear that 20-day moving average or that 10-day exponential moving average. Lower Bollinger Band right now is probably what you're looking for in terms of support, and maybe all the way down to around 157. When we look at euro dollar, the euro has certainly consolidated. It certainly has come down some. Right now, we're trading a little bit below the 10-day exponential, a little bit above or right at the 20-day moving average. So again, this is sort of where you would expect to find the euro to potentially find some support, potentially bounce back up. If that doesn't happen in the next day or two, if the jobs data here in the U.S. is relatively weak, then we're talking about probably a revisit to this lower Bollinger Band around the 108, 109 region. When we look at pound dollar, that's a similar story. We're finding support at the 10-day exponential moving average. That's a positive. There's obviously room to drift to around 130 or so. But the interesting thing is when you look at the pound and you look at it on a little bit of a tighter scale and you take these moving averages and stuff out, you can actually make a case that there's potentially a flag pattern forming in the pound, which could lead to a more significant rally for the pound versus the dollar, which could really send it much, much higher from here. Clearly, if we were to break this trend line, I'd be looking for a breakout above the 132.5 region. That's how I would look at this setup currently. And certainly when you look at it on from a technical basis, we're not even really overbought anymore. Those conditions have certainly eased. And so the setup here is quite favorable for the pound if this turns out to be an actual bull flag. Oil was down pretty sharply today. WTI down on the day about 5%. When we look at WTI, certainly we can make a case that we have broken an uptrend here. We've certainly broken these two lows. Again, the next meaningful level here for WTI appears to be at 67. When we look at it from this standpoint, you can see we're getting a little bit towards the lower Bollinger Band, but the RSI is still only 37. So this kind of suggests to me is that there is plenty of room to drop to around into the 67 region if we can get some more momentum. We've clearly failed 3 times at these upper trend line. And so again, it looks to me like the next major move here in oil is potentially lower still. Copper fell pretty sharply today. Right now we're at the 20-day moving average and just below the 10-day exponential moving average. The setup on the RSI doesn't look all that bearish, actually, which is what's surprising given that there was some negative commentary out of us today from some research shops on copper. You can see that the RSI is still trending higher. So I actually think that until you really see copper put in a couple of days below this 20-day moving average, I think you got to give it the benefit of the doubt that the move is still continuing up. This is a major level of support around the 415, 412, 415 area. And even with the negative commentary that was out, we really didn't break meaningfully below it. Obviously, if you put in another day or two below the 20-day and you really start seeing the 10-day also turning lower, that sort of changes things. Then you would start looking for it to come back down to this 395 region. We'll move over to the DAX. The DAX continues to really be an interesting chart, just because, again, the DAX did go on to make that all that new all-time high, even though you kind of wonder, what the driving forces or what the mechanics are that are driving it. The DAX did put in a bearish engulfing pattern today. Notice that right here. And it managed to take out about 3 days worth of trading. So this was a pretty significant change today. But right now we're still above the 10-day exponential moving average, which also corresponds with this level of support at 18,690. If we were to break below that, that certainly sets up a further drop to around 18,335 or so at the 20-day moving average. That would be the next level I'd be looking for. Given the weakness in the U.S. markets, I could certainly see the DAX starting the day lower on Wednesday. But again, your line of demarcation between uptrend and downtrend still remains with this 10-day exponential, and upside is probably somewhere to around 19,210. The FTSE was also weaker today, closed below the 10-day exponential moving average. Again, we're still above the 20-day, though. We really haven't put in enough at this point to say the trend has really shifted, although I have to admit, when you look at the chart, again, we failed at this 8,350 region. This has been a popular area that we have tend to fail out now a handful of times, and we have been unable to push through it, which really sort of tells you that even though we're still above the 20-day you really have to favor downside here with maybe a revisit to this lower Bollinger Band at around 8,100. The NASDAQ was weaker today. That bearish engulfing pattern that we were talking about previously, also in the NASDAQ, played out fairly well so far. We did get below the 20-day moving average today with that 3% decline. We're also below the 10-day exponential. Notice there's still a lot of room between here and where the lower Bollinger Band is. Notice the RSI is still only in the 40s. So the NASDAQ looks fairly weak here, and you could certainly make a case that the NASDAQ has a further decline to come. When you look at it from this standpoint as well, and you take a little bit of a closer look, you can see that this right here is an area of support. We broke through that. There's also this area down here with this giant gap that still needs to be filled. And then, of course, there's this gap over here that's a really suspicious gap that hasn't been filled yet either at 17,860. I know that sounds like a long distance away, but it could come up pretty quickly depending upon how the data goes the next couple of days. So I would be really aware of that. Conversely, just like we have this pattern here, where you see we have this straight line drop into the close and then this gap higher the next day taking out that high. Notice here we had something similar where on Friday we had a very big closing bar, about 50 basis points on a market on close imbalance, which is slightly different than the auctions that take place in Europe. But again, it happens at the end of the day, also like the auction process. But notice here we dropped sharply lower, taking out the low. So just like there's the chance for this gap to get filled because of that opening, there's also the chance that this gap gets filled. So while the setup certainly favors more downside, I think you have to be very mindful of the fact that you could see a very quick snapback type of rally back up to this 19,600 area. You really can't rule that out. And all it really might take is just, one day of gapping higher on some decent news following a job report or initial jobless claims or something along that line that gets the VIX moving down sharply and boosts the equity markets higher. So I think you just have to be very astute and aware of what's happening in these markets right now, especially given the fact that you've seen the VIX move back up towards 21. The S&P also has that similar sort of gap, so there's still that potential to snap back and rise back to around 5650 or so. The S&P also broke some important levels of support today around this 5550 area. We managed to hold on to this 55 and a quarter region. Clearly, the next areas that we're looking at here are 5450 and then again around 5350. And of course, like the NASDAQ, the S&P also has this giant gap that we need to be aware of down at 5,200, and then there's actually another one down here at 5,185. So there's plenty of room to continue to decline here in the NASDAQ and in the S&P. And the Dow also has broken this uptrend that was in place. We've now also came really close back to testing it. That was from Friday. Also gapped lower this morning and sold off. Notice where we stopped going down right here around support of 40,860. We're still looking at this gap that needs to be filled. And if, like last time we spoke about if we broke this level of support, we could fill the gap. Notice we're back in the same spot, still looking to see if we can break this level and still fill the gap basically at 40,050. So there's a lot of things going on this week. I think in the U.S. markets, you have to be astutely aware of this data and realize what your upside risks are here. Because if the data just comes in a little bit more favorable, or if implied volatility gets just high enough, you could get one of those violent Vanna rallies or volatility crushes, as I call them, which lead to that snapback rally. And there's a lot of room to the upside, 2-3%. If things really if that momentum really gets going. So something to be aware of and to be a little bit thoughtful of and over the next couple of days. Anyway, I hope you found this helpful. Until we talk again, have a great week. Bye.